Welcome, and today I have with me Astrid. She's a mortgage agent and she has a specialty that she loves and enjoy walking her and supporting her clients with, and that is the Smith maneuver. Astrid, thanks for joining me, and I'll allow you to give a full introduction of yourself.
Thanks, Guardian, for having me today. My name is Astrid and I'm a mortgage agent with Guardian Mortgages. We are one of the fastest growing brokerages in Canada. Now, my mission as a mortgage agent is to help homeowners save money and to change lives one mortgage at a time. As a mortgage agent, I take a financial planning approach to mortgages because I believe that your mortgage is likely your biggest debt. I believe that it should be considered as part of your entire financial plan. Now, I teach homeowners how to leverage their mortgage in order to turn it into a true asset. And I'm really excited about today's topic.
Awesome. Thank you. So let's dive right into it. Tell us, what is the Smith maneuver?
The Smith maneuver, okay, well, it is a strategy that allows you, the homeowner, to make a large investment using the equity in your home. And by doing so, if the investment is in a non-registered account, you're turning your mortgage into a tax-deductible mortgage. So it's also a tax strategy. And that's because when you borrow from your home to invest, the interest that you have to pay on that loan is a tax write-off.
Okay.
So that's essentially what that is.
Okay, so I guess there are three objectives then, right? Hopefully you'll be paying down your mortgage faster. Ultimately, you'll be freeing up funds using the equity to invest, and you'll be creating a tax deduction.
Exactly, yes.
Okay. So is there any more to the mechanics of Smith maneuver, or could you tell us who would be best in a position to use the Smith maneuver?
Yeah, so before I talk about that, I think I just want to explain how you would get this going in the first place, right?
Okay.
So essentially the way it works is that you would take out a loan against your house. So it's called a home equity line of credit. So it's a line of credit that's secured against your house. And with the home equity line of credit, we call it HELOC, you can borrow up to 65% of the value of your home.
65%?
So let's say 65%.
Mm-hmm.
So let's say that the value of your home is $1 million. You can effectively borrow up to $650,000. Now, if you still have a mortgage on it, so let's say your mortgage is $200,000, that means you have $450,000 credit limit that you can use to invest. So that's where the Smith maneuver comes in. Now you have the credit limit, and you can take that $450,000 and you can decide to invest it somewhere else, right?
Mm-hmm.
So who would use something like this? Well, first of all, you have to have a mortgage to make this work, and you have to have equity in your home. Now, because you can borrow up to 65% of the equity in your home, you need to have 35% equity, right? You need to have paid off at least like 35% of your mortgage to be able to make this work for you. And so for the Smith maneuver to work, you really need to have an investment mindset. You need to have a mindset where, you want to take a look at your mortgage is a debt, and how can you turn that debt into what I call good debt, right? So if you have that kind of mindset, you can definitely use the Smith maneuver to your advantage.
Okay, so in summary, someone with a mortgage that they've paid down significantly and want to actually put that equity to work by pulling out some of that dormant cash and putting it to work by using a HELOC to access the funds and then go and reinvest it in some other opportunity.
Right, exactly.
Okay, awesome. So from what I heard so far, you'll have a mortgage debt, but then you'll be also taking out new debt in the form of a HELOC. So how do you service your new HELOC when we're using the Smith maneuver?
Right, because obviously when you take out a HELOC, you have to pay the interest on it. It's interest only, right? So, there are different ways of doing it. If you have some positive cash flow that can cover the interest, that's one way to service it. Another way is depends on your investment. So let's say that you decide to use the equity to invest in real estate, for example, then you can use that rental income and that cash flow you're getting from the real estate investment to service the HELOC. You can also do that with some investments. If the investment pays dividends and you can actually get the dividends out, you can service it that way as well.
Okay, and I know too with the opportunity when applying for a HELOC is an opportunity to consolidate debt, right? So if you have high interest debt, at this point you can consider consolidating your debt for a lower interest rate, which actually does free up cash to help service the HELOC in the Smith maneuver. Is that right?
Yes, that's correct. Yes. You consolidate the debt, and it's also easier to pay down that debt as well when you're consolidating it.
Because now you have one payment instead of multiple.
Yeah, exactly.
And a lower interest rate instead of a high interest rate.
Well, that's exactly it. When you have multiple payments, a lot of the times what happens is you end up only paying interest only into the debt, right? Because you're trying to spread out, you're trying to make payments everywhere. But if you consolidate it, you're actually paying down the principal of that debt.
Yes. I especially love that opportunity because now we have we're in a higher interest rate environment. I understand we had a rate decrease, so I'm happy for that, but we're still in a higher interest rate environment. And when we can swap out high interest debt for lower interest debt, it is a cost savings, and it does free up that extra cash flow that we can use to further invest and accelerate our financial freedom. So, and one other thing I'd like to point out, especially at this point where you were talking about taking on additional debt in the form of a HELOC, is to ensure that you have sufficient life insurance coverage, because with the mortgage and the new HELOC, you want to make sure if something happens to you prematurely, that your family or your dependents are not burdened with clearing this debt, right? So life insurance proceeds would instead satisfy the debt, leave them with the assets that you invested in so they can live the quality lifestyle that I'm sure with doing this strategy, you were aiming to provide them in the first place. So just a ding ding right there.
No, that's a really good point. And often people get life insurance, maybe early on based on the mortgage that they have, right? But what happens is situations change, whether you end up getting a bigger mortgage or you end up refinancing and taking on a HELOC, your situation changes. So just because you've had life insurance before, it doesn't mean that's not enough for what's happening today or what's happening in the future. So exactly. I think life insurance is definitely something that everyone should look at on a regular basis to see whether or not they still have enough coverage to protect their assets.
Exactly. So with my clients, I tend to do like annual reviews, and I just check to see what situations in their lives would have changed that would require more coverage, more better or bigger safety net for their family. All right, so thank you for pointing that out. So I mentioned just before that we're in a high interest rate environment. Are there scenarios where the Smith maneuver might not work or might not be ideal?
Yes, for sure. So for the Smith maneuver to work, obviously your investment has to be bigger than the interest rate, essentially, right? So if we're in a high interest rate environment, and your investment is, let's say, only 1% bigger than the interest rate, then you have to ask yourself whether or not that 1% difference is worth it or not, right? Mm-hmm. So it all depends. Now, if you are investing in a non-registered account, the interest rate you're paying is a tax write-off. So it might still be okay for you to invest in a high interest environment. Again, it's a cost-benefit analysis, so you have to really take the different interest rates into account, the environment into account, and figure out whether or not it's something that you should do. Now,
okay.
If like in a high interest environment and you say, okay, it's not worth it because the interest rate is too high and I'm not making enough on the investment to make it worth it, you can still get the HELOC to prep for it, right? Mm-hmm. So you can refinance your home, restructure it to get the HELOC, and while you're waiting for the ideal situation for you to invest, you can actually pay down your mortgage at that time, because the more you pay down to your mortgage, the higher your credit limit becomes.
Mm-hmm. Awesome. So, one, if you're looking at using the Smith maneuver, you need to do some math to make sure that it works for you. You have to ensure that whatever planned return that you're getting on the investment that you have, it is greater over and above the interest cost, and also that the net benefit, including the tax write-off that you'll be getting, will make sense, financial sense.
Okay. Exactly.
Right? But in the meantime, it's always a win when you can pay down your mortgage debt faster, thus saving interest that you'd pay over time.
Exactly. Yes. Yeah. And we can, like, the Smith maneuver is one strategy, but we can always couple that with other strategies as well. For example, we have a strategy where we have a specific product, because a Smith maneuver, you obviously need a HELOC. You need a product that has a mortgage and HELOC component as well, right? But if you also add a checking account on top of it, what happens is as you get paid, you deposit money into that account. It effectively decreases the principal balance of your mortgage, so you can accelerate the principal pay down of your mortgage a lot faster as well.
Awesome. Yeah. And we want to pay off our debt. We want to have pure income coming into us, and that will accelerate our journey towards happy retirement and financial freedom, right?
Exactly.
So previously I'd mentioned one opportunity that we could pursue with taking out the HELOC and using up the equity in our home. You had mentioned investing in real estate, which is, to me, is awesome. I love real estate. But what other opportunities do you know of that you can use with HELOCs?
You can invest it into an investment fund. Again, if it's a non-registered investment fund, then the tax becomes a write-off. And I believe there's a life insurance product called segregated funds, right?
Yeah.
That's a good fund to invest in as well. You can use it you can become a private lender in the mortgage space. That's one way of doing it as well. So there's investment, real estate, private lending.
And in businesses, I think we could even invest in businesses as well. But as you mentioned, seg funds, that's where I come in, right? Insurance companies offer the opportunity to invest in different type of funds with different underlying assets or indexes. For example, the S&P 500, the NASDAQ, the TSX 60. Well, how a seg fund differs from a mutual fund is that the insurance companies, they tend to offer guarantees, right? Because insurance companies are in the business of offering guarantees. So on top of what you typically get at a bank, they'll offer the advantage of a maturity or death benefit guarantee, and also the option to reset. So do you know how this works? I could maybe give you some more info. With the guarantees, so for example, if you had an investment and at maturity the market is down, with a guarantee, it actually might be that the payout at the point of maturity or death is actually higher than the market value. So that's one of the benefits. It provides you with that principal protection. And I know some people are hesitant to invest because of the downside risk, right? So using a segregated funds kind of alleviates some of that downside risk.
Yeah, that's amazing. Yes, there are some people who are a little more risk averse.
Yeah.
And of course, afraid that, especially in an economy like today, is it a good time to invest when the economy is not doing so well, right? So when there's that principal guarantee, I think it could be a win-win all around.
Exactly, especially when you're planning for a long-term type of goal like retirement. That is definitely an advantage. And the resets, actually, they allow you to lock in gains along the way, right? And the guarantee is applied to the new reset amount. So if you had $100 invested, you got reset at 120. That guarantee is actually applied to the 120 as opposed to the 100. So that's another way that insurance companies offer you to help you grow your wealth and protect you against downside risk.
Oh, that's amazing. And you also mentioned as well investing in businesses, and that's another way as well to use the Smith maneuver is to invest in a business. And if you have even a side business, right, you're injecting money into your business, that's a loan you're taking from yourself, and that could also be a tax write-off.
Okay. And just to highlight here, right, we know that the tax deduction is one of the touted benefits of investing with a HELOC. There are certain product options that will not allow the tax deduction. For example, if you were to invest in a tax-free savings account, or if you were to invest inside of your life insurance policy, which again is another awesome thing to do, right? That if you borrow to do that, then the interest associated with that borrowing is not tax deductible.
That's right. Yes, that's right. That doesn't mean that it's still not a good idea. Again, it all comes down to math and doing a cost benefit analysis.
Great. Yeah. All right. So you mentioned a few things, and there were a few things that popped out to me about the person themselves that would see this as an opportunity, right? They have to have certain qualities or a certain outlook. For example, you mentioned that they must have an investment attitude, right? They must be open to risk, because with any investment there is a measure of risk. Is there any other quality that you'd expect them to have when you're considering a client for the Smith maneuver?
Yeah, they have to have financial literacy, or at least be willing to learn about being financially literate, understanding how all of that works. They have to be disciplined as well, right? Because all of a sudden, if you get access to $450,000, you don't want to go out and buy a Ferrari with it, right? So again, that's kind of like where the investment mindset comes in, right? So discipline, financially, you have to be able to protect your credit score, because credit is really important. And you have to have a growth mindset.
Okay, awesome. Growth mindset, discipline when it comes to investing and managing your credit. And I think I mentioned a long-term outlook, because this isn't a short-term play, right?
That's right.
A long-term outlook on your investing and your time horizons, and also a healthy risk appetite, because whether or not you're going into real estate with the HELOC, buying into a business, or even investing in other funds, right? There is a measure of risk that you would need to accept.
Absolutely. Yeah.
Yeah. And you did mention, Astrid, that you've actually employed this strategy in your own life. And I'd love to hear what you did and how it's working out for you.
Yeah. So we employed this strategy actually a while ago, over 10 years ago now, where we did exactly what we talked about, took the equity from our home and bought a condo with it. So now we own a condo in Toronto. And of course, that was a good investment, because when we bought the condo, it was, $360,000 or something like that, right? Now condos in Toronto are, it's probably valued at about $1 million. So you could probably do the math there in terms of like our return from it, right? And in the meantime, yes, we've been paying the interest on it, but at the same time, again, the interest is tax deductible. So it's really, to us, it's a moot point. Now, I mentioned that Smith maneuver is one strategy, and of course, as an agent, we have access to different strategies as well. So what we can do is we can stack strategies, and that's exactly what I've done with our own personal situation with stacked strategies. So we started the Smith maneuver over 10 years ago, and more recently, we have a strategy at our brokerage called the All Your Money Everyday AIM mortgage strategy, and it's essentially creating your own banking system, right? So with this strategy, and I mentioned slightly before, it's an all-in-one account. It has your checking account, your mortgage, your HELOC in one. So every time we have income coming in, it pays down our principal balance right away. And now, instead of having a 25-year amortization, instead of taking 25 years to pay off our mortgage, we are now on track to pay it off in about 9 years. So awesome. I think that's really powerful. Now we're coupling that. I'm not sure if you've heard of the cash damming when you are in real estate and you're a real estate investor. There's a strategy called cash damming, and that's probably topic for another day. But basically, whenever you're using your equity towards an investment, and so what this means is I'm using my equity to pay for the condo expenses. So the expenses, the interest that I'm paying on the expenses now become tax deductible as well. So that, to me, that's 3 strategies in one that we're employing for our own personal situation. And when we do that, we're paying off our mortgage even faster.
And that's the goal. If you have a real estate portfolio, right now we might be getting smaller net cash flows, but the faster we pay down that portfolio, the larger our net cash flow becomes, right? And that does accelerate, again, the goal, financial freedom, the goal of early retirement. And you mentioned several strategies, and we'll definitely have future conversations about those other strategies, because the goal of this broadcast is to help everybody achieve the goal of financial freedom. Everybody learn the strategies that they can employ with the assets they have, with the resources they have, wherever they are at financially. They can learn and employ strategies to help them get there, because that's how we do it. I know you have the similar goal, Astrid, to help individuals achieve financial freedom one step at a time.
Yes, that's exactly it. And I always say that it's not too early to start learning, and it's not too late to start either, right?
Exactly. Thank you so much, Astrid. Is there any parting words for our listeners that you'd want to share, or even if you want to just tell them how they can get in touch with you?
Sure, yeah. I just mentioned, it's really not too early to start learning about some of the strategies. And even if, we don't know what your situation is like, but it starts with a conversation. So have a conversation with me, have a conversation with Cardine about the life insurance portion, protecting your assets, and even about segregated funds, right? To learn more about how that works. And really, I'm here to help. I don't actually charge for my services. So come talk to me anytime. You can send me an email at astrid@guardianmortgages.ca, or DM me on Instagram or LinkedIn, or send me a text or call me at 289-809-4599.
Awesome, Astrid. Thank you so much. And everybody knows how to get in touch with me, I hope, by now. info@moneymattersca.com, and you can call me at 647-951-6905. My conversations are also complimentary, so reach out. You have no excuse. Take care.
Thanks, everyone. It's Cardine.
Bye.
Bye.